I guarantee you are wasting money on your taxes if you're doing short-term rentals and Airbnbs and not understanding the exact rules to it. Trust me, I know this because I'm that same person. I've spent way more on taxes than I need to, way more on bad CPAs and accountants than I needed to, all throughout my short-term rental investing journey. Luckily, I have some expert CPAs on that actually understand as a real estate investor what you need to do from the short-term rental side and all the gray areas that go around it. Today's episode is going to be all about putting more money in your pocket, and dare I say it, actually kind of like tax season when it comes around. Let's get into it. Running short-term rentals is constant work. Guest in, guest out, and you're still expected to be your own bookkeeper? I had multiple listings going and no real way to manage the money that was coming in. Between flipping beds and trying to match receipts from a payment a month ago, I couldn't even know if I was making real money. That's when I found Baselane. It's the official banking platform of BiggerPockets, and it handles all of the tracking and reporting I used to do manually. Now I can see real-time financial reports for each listing and know if there's a problem that's arising. For example, last month I had a 300% spike in my electric at one of my properties, and I realized that I needed to do something. I quickly set up a smart thermostat inside of it, and my electricity bill was cut almost in half. Thanks to things like Baselane, I avoided losing my profits and actually getting them back in my pocket. Start protecting your profits today by signing up at baselane.com/BP, and you'll get your $100 bonus right when you sign up. Hey everyone, welcome back to another episode of Bigger Stays. My name is Garrett Brown. I'm the resident BiggerPockets STR expert. And today we are talking taxes, but don't click away. I promise this is going to be one that actually is something of value to you. We have a few experts in the field on, Amanda and Matt from Keystone CPA. Welcome to the show.
Yeah, thanks for having us, Garrett. It's good to be here.
Yeah, excited to be here.
I'm sure people hear taxes, especially in the middle of the year, and are probably like, oh, I don't know if that's something I really care about now. I'll worry about it in February, when there's actually the biggest chance to get more money into your pocket right now by understanding what you can do in this day and age to can push your profits even further, but also with all of these changes that are happening right now. I'm sure y'all have heard about the one big beautiful bill. What are y'all's thoughts on it, and how is this going to change things for STR investors for the rest of the year and going forward?
I feel like if you invest in short-term rentals, you have to have at least a basic understanding of taxes, because it's one of the few investment classes that really could help virtually everyone, anyone save on taxes. And we have clients who are, working full-time, teachers, high-income earners, professional athletes, celebrities that all use the short-term rental tax loophole. And the One Big Beautiful Bill basically, more than doubled the potential tax savings benefit for real estate investors. So yes, now is the time to be talking about it, not next February or next April.
We're just happy it finally passed, because they've been talking about it for like 8 months, and it was kind of like if and when and if,
I used it as quite a few times as a news piece, but every time I was talking about it all year, it was like, is it going to go through? And now we're finally here. So we hear about the short-term rental tax loophole, I'm saying in quotations, all the time, and it's actually written into the IRS code, which people, when they put the term loophole on it, you think you're doing something kind of sneaky. How does this, change with the One Big Beautiful Bill lead into the STR tax loophole? And what exactly is this loophole that everybody talks about?
Well, like I said, the One Big Beautiful Bill effectively, doubled or more than doubled the potential savings from the short-term rental tax loophole. The reason it's called a loophole is because in traditional long-term and mid-term rental investing, someone who has higher income, so $150,000 or more, you generally cannot use real estate tax benefits like depreciation and write-offs. You can't really use those losses to offset W-2 income. Versus if you invest in a short-term rental, it's much easier and possible to use short-term rental tax losses to offset W-2 and other income. So that's the reason why it's called a loophole, because the traditional long-term space, it's more difficult for people to use it against W-2.
And when we talk about losses, on the short-term rentals, we're not necessarily talking about people losing money. Obviously, we don't want people to lose money, but we're talking about strategically creating losses on paper through things like depreciation, right? We're depreciating our building. We're writing off all the furniture we put into our property, writing off all the supplies we put in the property, and that One Big Beautiful Bill brought back bonus depreciation, which, to Amanda's point, can essentially double the benefits of a lot of the depreciation people are getting on their furniture and their equipment and their land improvements and their short-term rentals. So we're expecting to see huge benefits for our short-term rental investors and clients going forward.
For somebody that has no idea, what exactly is bonus depreciation? Like, how does that, like, to me, as I hear that the first time I heard it, I'm thinking like all I know is about cars, depreciating when they're coming off the lot. And like, what exactly how does that play into short-term rentals?
Depreciation is kind of that tool of the IRS. Basically, they give you this ability to write off a part of the purchase price of your property every year. Totally different than investing in stocks, right? You go out and buy a stock, you're not writing off the cost of stock right now. You can't even write that off until down the road when you sell it. But that's the beauty of investing in rental properties. The IRS says, hey, due to normal wear and tear, you can take some depreciation write-off every year. And there's certain calculations. You write off a building, a residential short-term rental building over 39 years. But bonus depreciation basically comes in and says, for certain assets like that are classified as 5-year property or 15-year property, instead of writing those off over 5 or 15 years, we can take extra depreciation, essentially writing it off all in 1 year alone. So that's kind of why it's called bonus depreciation, is that instead of writing off for 5 or 15 years, you get to take it all right now. And so you can't do it all on the entire building, but you can do it on those certain chunks of assets. And again, in the right scenarios, that can add up to a lot of money, especially with people who are putting in higher end stuff in their properties, furniture, fixtures, all that kind of good stuff, or putting in new flooring, all that kind of things.
How would you even figure out this bonus depreciation thing? Like, can you just get out a piece of paper and write down how much you think a microwave is, or is there like a more strategic way to go about this?
I wish it was just a way that you just make it up.
But that'd be nice.
So for a short-term rental investor, obviously, if you buy a property that's vacant, right, you're going to furnish it, you're going to stage it, so you know how much you're paying. And so the tip for you as an investor is you don't have to understand the law. You don't have to understand like how to calculate and do all that stuff. Your job is to make sure you have a pretty good itemized listing of how much did I spend on appliances. I don't really care about microwave versus dishwasher, but like how much did I spend on appliances? How much did I spend on furniture? How much did I spend on fixtures or supplies, right? And so with that type of category, then your CPA, your tax person, will be able to help accelerate the write-offs based on those things. Now, accelerated depreciation is, for the building part, that's the part that's more difficult because I paid $400,000 for a short-term rental. I don't know how much makes up the specialty plumbing, specialty electrical. And that's where you have a cost segregation company where they come out and they basically help you to analyze with using IRS guidelines how much of that purchase price is different asset classes. So again, for the investors, you don't have to become a CPA and memorize the law. All you have to do is keep detailed record of what you are putting into the property.
I hear the term cost segregation a lot, and a lot of people probably don't fully understand what it is. Is a cost segregation study smart for every investor that buys a short-term rental, or is there times that it's not something that somebody should possibly look into or pay to do?
You're totally right. It's not the right thing for every investor, so there are certain times when it does make sense for short-term rental operators and investors, if they are involved in the day-to-day operations, self-managing their properties where they can meet the IRS thresholds to treat it as like an active business instead of like a passive thing, then they're going to be able to deduct those losses. And that would be a situation where we want to create more losses on paper like we were talking about, right? So that was where a situation where a cost segregation study might make sense. But again, if they can't meet those requirements and the short-term rental is going to be passive, may not make sense. If they're already in a very low tax bracket, may not make sense to pay a lot of money to create losses that you're not sure when you're going to use them going forward. So there are different ways to do it, but yeah, it's not a one size fits all for sure.
I hear about this thing, material participation, a lot in the short-term rental space. Can you define that a little bit, and like how can somebody qualify for that? And because I think that's where some people kind of get tripped up thinking about, do I need to track hours? Do I need to clean every property and never have anybody work under me? So can y'all break that down a little bit from a CPA perspective?
Sounds like you've had these conversations.
Internally, I probably have. So
material participation, the term for tax purposes is, someone being involved in the day-to-day operations of a specific business. In this context, we're talking about the short-term rental. Examples of material participation hours, right, is you getting the property ready, staged and ready and furnished, dealing with guest relations, guest issues, right? Check-in, check-out, their inquiries, could include cleaning, restocking stuff, but it doesn't have to be any one of those specific things. So yes, we do have clients who meet material participation, but they'll have a cleaning crew. They have handymen who do those things. Even sometimes if you have property management company, you could still potentially meet material participation. And again, why do we care? Because if you meet material participation, then your rental losses from your short-term rentals can offset taxes from W-2 income. So when you hear someone say, I made $200,000 last year, I paid no taxes because I bought 1 or 2 short-term rentals, it is because they used material participation. There's several different ways to qualify for the hours, but I think we could just talk about the most common 3.
Yeah, there's the IRS has a laundry list of 6 or 7 different tests you can meet, but basically 3 of them apply to 99% of the people out there. The first one is, did somebody spend at least 500 hours during the year working on their short-term rental or short-term rentals? If you did that on your own, or you and your spouse had 500 hours, doesn't matter that you got a cleaning crew. It doesn't matter how much time anyone else spends on the property. You don't care. If you can't get to 500 hours for some reason, then we go down to the next test. Did you spend at least 100 hours? And it's more time than any other single person spent on your property. So again, I don't know, you spent 150 and you look around and the next closest person spent 120, then you're good to go. But in that situation, you are kind of comparing your hours to somebody else's hours. And then the third one is add up all the time you spent on it, as long as it's more time than all the time anyone else spent on your properties. Doesn't matter how much time you have, daytime, as long as your time is more than theirs combined, then you're good to go. So a couple different ways to do it. The 500-hour test is kind of like, we call it the gold standard because you don't care about anyone else's time. The other ones, you need to have an idea of your time and theirs. But to your point, it is, from a risk perspective, you want to definitely document your time, because if you were to get audited for some reason, that would be one of the first questions the IRS brings up.
How does someone document their time? Is it as simple as pulling out a notepad and writing things down, or like what have you seen actually work?
Some of our clients, I think, still do that on paper. I don't know if I recommend that, but I mean,
They have a briefcase still?
Yeah, that's possible.
You look too young to be a notepad documenting person.
No, I'm definitely not. I'm an iPad kid. So
the IRS doesn't have a requirement for how you document. What they do require is a consistent methodology. So it could be your Google Calendar, documenting the hours. It could be an Excel spreadsheet. One of our clients created an app. It's called Reps Tracker. But what's more important is, what are you documenting, right? So what you're documenting is like the dates, obviously, the property that I'm involved in. If you have one short-term rental, that's easy. You got multiple, then the IRS wants to see which property is it you're talking about. What did you do? I was I was trying to get the cleaning crew to come out. I called the servicer for the spa to be cleaned. So what did you do? And then lastly, how much time did you spend? Right. And what's really interesting, because I was just talking to a client and she asked me, who do I give my time card to? Do I give it to you, the CPA?
Put it in the machine on the wall. No, I'm dating myself. Sorry.
But I said, it's actually an honor system. So that time tracking, it's all just for you internally. And like Matt said, the only time you ever produce it is if you're audited and if the IRS is challenging your position of having those hours. That's when you would say, okay, well, here's my time log from 2022. And then what they'll do is they'll do a sample selection. They'll take maybe 10 line items and say, okay, prove to me that you were here, you did this. So you would naturally have like receipts or cell phone records, emails and different correspondences on what you did. So yeah, it's not super difficult. It's not a clock in, clock out every day sort of a thing.
So my method would have been, I sometimes mark things in like an Excel spreadsheet and try to stay ahead of it, but there's times where every week I can't mark these things down. So if I'm doing it once a month or once every couple months, is that probably okay? Or are they wanting are you expecting them to want more rigorous style of documentation here?
Yeah, that's a good question, right? Because people are often like, well, how detailed do I have to be? Is it a daily? Is it an hourly? And the way I would look at it is from the use perspective. Like I said, if you're audited, they're going to look at your time log and they're going to do sample selection. So I would rather my sample selection be like a couple hours rather than a couple days, because then I got to prove a couple days worth of things. And how detailed do you need to be? Well, you need to be detailed enough where you can recall how you're going to be able to prove something. right? So it's really almost like internal notes for myself. Like, okay, I said I did these things. How do I prove it? Because I have, I don't know, receipts or emails or whatever that happens to be. But also the IRS, I know a lot of people are afraid of audits. And especially when they hear about like the loophole, it's like, oh my gosh, I'm like you said, borderline, doing illegal stuff. But the reality is it's something totally allowed by the IRS. It's something that's gone to court actually many times, U.S. tax court, and won. But it is a big dollar amount when we talk about short-term rental or any kind of real estate benefit, right? Depreciation, we're not writing off 1,000 or 5,000. We're writing off 50, 100, 200, 300,000. And because the deduction is so large, the more you can do to document your positions and, keep your receipts and things like that, the better it is, because you just hate to lose an audit where you claim such a big write-off that you're no longer able to support. So based on the risk tolerance, and auditors are pretty normal people. They're not like the monsters that a lot of CPAs pitch them out to be. They're reasonable. Like, oh, you logged in 10 hours to build a bed and a desk. Like, okay, that's kind of what I would take. So it makes sense. You log in 80 hours. It's like, no, that doesn't make sense.
That was one thing that I was always afraid of, especially the further I got into my own real estate investing side, is, the dreaded audit. Is there like red flags or common mistakes that you see people make when they're coming to y'all that you immediately are like, hey, that's probably not something that you should be doing because that might trigger some bigger things down the line? Or is it kind of like you never really know what may trigger an audit?
Yeah, there's certainly some things that are typical red flags. But to your point, some of it is kind of, it's an unknown, right? The IRS isn't going to go out and kind of disclose exactly. Even if you ask them sometimes, hey, why was this return selected for audit? Sometimes they'll just give you some, mumbo jumbo, right? Some things that I think stand out to us, like when we get new clients come to us, we look at previous tax returns as kind of one of our service things. Sometimes there'll be people that are, using round numbers on all their expenses. That's probably not recommended. I'm sure you didn't spend exactly $1,800 on that, right? Or everything that ends in zeros, right? So that's one thing. So other ones, we've seen people like they're, on a rental property schedule on a Schedule E has specific lines for advertising, utilities, but then they got other deductions, right? And then you can enter stuff in your software there, and people sometimes will put like credit card payments. Well, that's not a good one either, because that credit card payment covered 5 or 6 different expenses, if not more, right? So you want to break those out into the appropriate categories. I think those are a couple that come to mind right away, I think.
I will say people, it's not uncommon, like you said, you're super, or you were or are super afraid of audits. A lot of CPAs are afraid of audits, and I think unfortunately it's the CPAs who kind of drill it into clients' head, like, audits are so scary. Don't write off a home office, you'll be audited. Don't write off too much, you'll be audited. When the reality is it's really not about that. What we see creates an audit is not really write-offs per se. It's actually silly things like tax forms not matching. So like if you got a property on Airbnb and you own your real estate in an LLC, right? But Airbnb issued the 1099 to your personal name. However, you report it in an LLC. Something so silly of a matching thing is what prompts an audit, because guess what? The IRS was expecting to see that income on your personal return, but they didn't because you put it on an LLC. And so that's why we always tell our clients, especially if, getting 1099s, having 1098s, we want to try to make sure all that document matches how we're reporting things. So people who haphazardly form LLCs but aren't using it correctly, those are times where you're like, okay, you're audited. And again, no good reasons except for the fact that IRS didn't see that matched up.
You want to be thorough in organizing your documentation, because 1099s are missing, 1098s, W-2s have nothing to do with your rental properties. That could be something that they open an audit for, and then, hey, let's look at some other stuff going on here, and so you just want to be diligent and making sure you've captured everything so that you're kind of minimizing that risk as much as you can.
So you're telling me that the government was doing some things and they couldn't explain why they were doing it. That's a profound thing that I haven't seen before. So
that's the soundbite from today.
All these things that we talk about, you hear so much negative things about taxes and audits and all that, but there's actually some positive things if you're working with the right people, like the correct CPAs, like Keystone CPA, to actually, help you figure out how to navigate this tax code and things that are always changing. What is something that over the rest of the year that in a short-term rental investor, either they just got their property or they're considering getting a property, what are a few tips, actionable tips for them that they could implement to like make tax time not as stressful and maybe even get some money back in their pocket as they're, starting to expand their business?
Yeah, I mean, I will say again, if you invest in short-term rentals and you are still paying a lot in taxes, probably one of two things must be true, right? One, you don't own enough rental real estate because you have to own new real estate to get the benefits. Or two, you're not working with the right CPA or tax advisor. Because again, short-term rental loophole is something that's helpful for all types of taxpayer, whether you're full-time or part-time, young or old, high income, low income. And so, just making sure you understand how to track your hours, you understand how to use it to offset W-2 and other income, and earning those hours legitimately before the end of the year, right? Because it's one thing to understand, sure, I can do those things, but we can't haphazardly say, maybe I sort of did it, I'll just say I did. You really want to be doing those right things. And so if it means being more hands-on with your rentals, great. If it means you should buy more rentals, great, right? So those are the things to kind of think about between now and the end of the year.
Yeah, because there's, tax world, there's some things you can do in April to save taxes for the previous year, but making up hours and coming up and making sure you qualify for hours is not something you can do after the fact, right? So for the short-term rental operators out, I would just kind of reiterate what Amanda said, is just being proactive about documenting your time, understanding what's available to you, taking advantage of it. Like I said, we're going to have probably a lot of clients going out and buying additional short-term rental properties before the end of the year to maximize that potential depreciation write-off, especially given the changes with the recent bill. So that's what we're expecting to coming down the pipeline.
We'll kind of start wrapping it up with that last note, because that was one of the final questions I wanted to ask. Say somebody did want to buy a property this year and benefit from the 100% bonus depreciation. How much time, say it takes them a month to buy the property and a month to 2 months to get into operation. Would they be able to qualify in time, do you think so, for this bonus depreciation? Or has that ship sailed a little bit? Or what are your thoughts?
Possibly. I mean, the earlier you plan, the more options you have. So obviously, if we were having this conversation in January, you had all year to shop, right? But now is still a good time, because you still have a couple months before the end of the year. So it's still time to acquire, put the properties in service. That's key. We can't just buy it. We have to actually rent it out before the end of the year, and then track your hours, right? I mean, we talked about the 500 hours between you and a spouse. But some of the other ones, you could do it with as little as 100 hours. So one of the strategies for closer to year end is if you put something in service in November or December and you're self-managing it, then maybe with even 100 hours, you could use the short-term rental loophole in 2025, as long as nobody else has more time than you. So it's definitely possible, but it's a whole different conversation if we're talking about the same thing in November. Because then it's like, wow, crunch time. Do I have time to buy the right properties, put it in service, and do all the things?
And you also don't want to buy bad just to try to get the tax benefit from it. Yeah, that's going down a slippery slope. And I've seen people try to take advantage of weird, interest rates or things like that, which is, there's no way to come back from buying it bad when you start. So I appreciate y'all jumping on today. I always try to highlight how there's so much tax code that's changing. There's so many things to understand, but one of the few, people that you work with that I say to never go cheap on, and I have a funny story to wrap things up that I'm sure y'all will laugh at this. When I first got into real estate, I went cheap on a CPA in quotation marks. He ended up not even being an actual CPA, right? He came very recommended on a Facebook group. This was 7 or 8 years ago. And I was like, okay, I talked with him. He talked a great game. I didn't really know what questions to ask. And so I was just like, oh, this sounds great. So we start to do our, go through my tax returns. And at the time I had my real estate business and another little side business. And he sends me an email one day out of nowhere. I can't even remember what the cost was per, maybe it was $1,200 per tax return, but he sends me an email out of nowhere and he goes, hey, we're slashing all, and I didn't ask for anything either. He goes, we're slashing all the costs and it's only going to be $300 per tax return for you. And I was like, oh, okay, well, that's awesome. I don't know why you're doing this. And I went through with him. And he absolutely butchered every single bit of my taxes to the point that I had to pay somebody else a few $1,000s in a few months later to just correct everything wrong that he had done. Filed the wrong forms, did all these things wrong. So I tell that story to just highlight to people that you get what you pay for in a lot of these things. And if your CPA or bookkeeper or accountant or whoever they claim to be is, throwing off discount deals right around tax time, it's probably time to find a new CPA to work with. You want to know a red flag for a CPA? When they're giving you 75% discounts in March. That's when there's a red flag going up.
The takeaway though is at least you only paid $300 to get it wrong instead of $1,200.
Yeah,
right?
it could have been worse.
I think he knew it was going to be wrong, so he was like, let me just go ahead and get ahead of this. So
I'm not doing anything anyway. Let me just cut the prices.
Oh my gosh, I love it. I'm stealing this story, by the way, Garrett. I am stealing this story, and I'm going to share.
This is our friend's story.
Yes, I once met a guy.
Yeah, I know a guy that met a guy. Yep. So, well, I appreciate y'all for jumping on today. Anybody that has any questions or anything, please let them know in the comments below. We'll have Amanda and Matt come back on for a part 2, probably at the end of the year when it gets a little more in tax crunch time if they have the time. And then we would love to answer any other questions or comments that come out. If you made it this long, please subscribe to the channel, and we'll see y'all in the next one. Take care.